So portfolio analysis, to be specific, intermediate level is risk and return. And I want us to start with the last sitting. So open the last sitting paper, December 2024. So we start with the last sitting paper, which is December 2024. And it was there in question number, what? Question number 5C. Question number 5C. Question number 5C. And the question says, someone to read for us. Let me ask someone to read for us. Nani hajaiongea hapa? Joseph Mwema, tulisome. Joseph. And you be the right number mkue very fast so that we can do more. I hope everyone has the first paper nimetuma kwa group. Joseph. Let me share the paper. So this is the question. Question number 5C. Let me just read it. So the return of Suffolk Limited shares and return on the Security Exchange Index and the share probabilities in the different possible outcomes of the economy that might prevail the next year are illustrated below. So we have the economic condition, we have the rapid expansion, moderate expansion, and then where we have no growth, we have their probabilities, we have their market return, and we have the Sofx limited return. So required the expected return of the market and that of Sofx. You need to compute the return of the market and that one of the Suffolk Limited. Number 2, correlation of coefficients between the return of the security exchange with that of the Soflax. So come out, you don't have that question, you screenshot, but I have shared the PDF with you. That one is okay. Now I will stop sharing. Let us do that question together. So number 1, let us start with computation of expected return. So we have, so what we need is the we have the market return, which is in percentage. Then the other one is okay, which is 25, 20, and 15. Then we have the probability. The probability is 0.3, 0.450, and 0.25. It's supposed to be 0.25 and 0.45. So let us have the first one, expected return of that market. So we said yes the other day that for you to get the expected return, in this case, it will be equal to the summation of. Now, remember we have the state of nature, state of nature and So state of nature, we have rapid expansion as denoted by E. This one is rapid expansion. We have the moderate expansion, and we have no growth. No growth. So ikiwa hivyo, I think ikiwa hivyo itakuwa sawa. I think tukiweka hivyo it will be okay. So for you to get the expected return of the market, let us say the expected return of the market will be equal to the summation of return of the rapid expansion multiplied with the probability of rapid expansion. We add a return of the moderate expansion, multiplied with the probability of moderate expansion, and then we add return of no growth, multiplied with the probability of no growth. That is the formula that you need. So the summation of the return. So RE means rapid expansion. ME means moderate expansion, and then NG means no growth. So look at the first one. So expected return of the market will be equal to, tunaanza na return the return in percentage. Remember we said it's supposed to be in percentage. So the return of rapid growth ni 25 times its probability yake ni ngapi? Ni 0.3 plus tukienda kwa moderate expansion, the return is 20. Probability ya moderate expansion ni 0.25 plus tukienda kwa no growth ni 15 times 0.45. So find the answer to that one. So the answer, what will be the answer? Itakuwa ni 25 times 0.3, 20 times 0.25, then 15 times 0.45. 15 times 0.45, which is equal to 19.25%. So 19.25%. So that is the expected return. That is the expected return for the market. So this one is for the market. For the market, which is related by M. You need to find the expected return for the other part. Let us write them down. Let us write the information. So for rapid expansion, moderate expansion, and no growth. So we have the Suffolks Limited. Suffolks Limited. So limited. So it is in percentage. So their percentages, we have 13, 10, and 8. 13, 10, and 8. Then their probability, we have 0.3, 0.25, 0.45. Then we say expected return. So we say expected return of the, let's call it Suffolks as SF. SF means Suffolks. So expected return of the Suffolks. So ER, SFS, SF means Suffolks. And then we say S for Suffolks. And then M for market return. This one M is for market return, but S is for Suffolks. So it will be equal to the same R of the rapid expansion and the probability of the rapid expansion plus return. So R means return of moderate expansion multiplied with the probability of the moderate expansion. Then tunamalizia na return of no growth multiplied with the probability of no growth. Remember the word R. Remember this R means return. Remember R means return. Return, which it must be. We said it must be in percentage. Must be in percentage. Come even percentage, you need to convert it to percentage. But the question is to partake in percentage, that one is okay. So tunafanya direct because already it is in percentage. So that's why tuambia the items are in percentage. So tunasema, so expected return of the Suffolks itakuwa ni tunaanza na ya kwanza, the return of the return of the market condition when it is rapid expansion is 13. You multiply with the probability, which is 0.3 plus when it is market, when there is moderate expansion, it is 10 times 0.25, and then when it is no growth, it is 8 times 0.45. So give me the return for that one. So that 10 times 0.3, 10 times 0.25, 8 times 0.45, which is equals to 10%. So that's part A. Part B. That's part A. So part A required us to compute what is called. Part A requires us to compute what is called the expected return for the two market. Number two, we're supposed to compute correlation coefficients. correlation of coefficient, which is given by R. So that is R of, so tunasema of M and S. So because we have the market, M means market, S means surplus. So we have two. So we have the one for market and the one for, this one is for surplus. Surplus. So this one is the coefficient for the market and for the surplus. So R for M and S. So how do we get it? So this is the formula. There's a covariance of market and surplus. So covariance of the market. Kuna mtu amepotea text. Okay, sasa 10. Olivia, thank you. So covariance of market and that of security, you divide it by the standard deviation of S, of standard deviation of the market, of the surplus, you multiply the standard deviation of the market. So you need to find all those items. So present as the first one, let us start by computing standard deviation. So remember, standard deviation is the square root of variance. So remember, standard deviation is the square root of variance. How do we get variance? Variance is given by summation of our return minus expected return squared times probability times probability. So let us start with the one for the market. So we start with the one for the market. We start with the one for the market. Now together at the first one for the market, our return. So then at the first one here for when we have what we call the rapid expansion. So we have tunaanza na hiyo. So we start with that one. So tunaanza na hiyo. Tunaanza na hiyo. So mnanisikia by the way? I think wananisikia sasa. Najua ni kama niko dunia yangu. So tunaanza na rapid. Now this is the formula. You can see this is the formula. So tunaanza na return. So return ndio hii hapa, the normal return. Tunaanza na the first one rapid, which is 25. We minus our expected return. So our expected return for, remember we are looking for the market. So for market, the here hapa our expected return is 19.25. 19.25 squared. We multiply with our probability. Our probability is 0.3. Ya pili tunaenda sorry. Just give me a moment. Just a moment. So I'm going to I was not recording, so you're supposed to record. So that's how you get the variance. The variance. So for you to get the variance, you find the summation of the difference between return and the expected return, as you can see here. Then once you get the summation of the variance, then you find the square root to get the standard deviation. So the same process you repeat to get the standard deviation. So this is the standard deviation for the market. So this one is the standard deviation for the market, as you can see. So deviation market. So we need to find for surplus. For surplus, for same formula. So you compute the variance first. Variance is the summation of return minus expected return squared times probability times probability times probability. So start with the first one. Start with the rapid expansion. We start with the rapid expansion. So how do we do the rapid expansion? Tunakuja tunaanzia na return. So tunaanza na return R, which is 13. We minus expected return. So expected return for surplus ndio hii hapa. What we compute. As you can see is 10 squared times probability, which is 0.3. 0.7 ndio hii hapa. You can see it here. 0.3. Then we go to moderate expansion. So our return in this point is 10. Our expected return ndio hii is still 10 squared. You multiply with 0.25. 0.25. Then we go to no growth. We go to no growth. Our no growth, our return is 8. We minus with our expected, which is 10 squared times 0.45. You add together to get the variance. You add them together to get the variance. So 10, so sorry, 13 minus 10. So 13 minus 10 squared. Then you multiply with 0.3. Sorry, 13 minus 10 is supposed to be 13 minus 10 squared, which is 9 times 0.3, which is 2.7. Then this one is 0 minus 0 is 0 squared. 0 times the answer is 0. Then 8 minus 10 squared times 0.45, which is 1.8. 1.8. So 2.7 plus 1.8, which is 4.5. Now the standard deviation of subflux. So standard deviation of subflux, which is subflux means S. You find the square root of the answer, which is 2.12. 2.12%. So we have managed to get the standard deviation is yapa. Now what remains is covariance. So you need to compute covariance. So covariance, how do you get the covariance of those two items? So allow me to rub the upper part. And rub this part. You allow me to rub this part so that we can get the covariance. So that we can get the covariance. So covariance is in M or M and S, depending with what you want. So tutasema, it will be equal to the summation of the return of S minus expected return of S. S means subflux. So S means subflux. With that one of the market, return of the market minus the expected return of the market times the probability. That is the formula for covariance. That is the formula for covariance. I think that one is okay. I think no one has any question concerning that formula. So we gave those formulas yesterday. So those formulas we gave them yesterday. So those formulas we gave them yesterday. So I think you are conversant those formulas. So let us start with moderate expansion. We start with moderate expansion. Then we go to the others. Hiyo haina mambo, hiyo tu ni hivyo direct as it is. That is direct as it is. So let me show you. Let me use a different pen. So tunaanza na ME. I think we that's moderate. That is moderate, rapid. That is a rapid expansion. So tuanze. So ya kwanza. So let me do away with these sticks so that we can start out here. It wasn't the first one when R is 25. Expected time for subflux ilikuwa ngapi? Oh, tuko kwa subflux, I mean, so tuko kwa subflux. Hapa 13. Tuko kwanza na subflux. Supposed to be 13. What was the expected return for subflux? Expected return for subflux was 10. So ndio hii hapa. 10. Then is 25. So when we go to the market, so and the rapid expansion is 25. 25 minus expected return hii hapa. Expected return was 19.25. Was 19.25. 19.25. Then we multiply with the probability, which is the same 0.3. So hiyo ni ya kwanza. So that one is the first one. So that one is the first one. Tukimaliza tunaenda kwa the next one. Tunaenda kwa next one, which is moderate expansion. So moderate expansion, surplus, when the return is 10, the return is 10, expected return is also 10. We remember the expected return for surplus was also 10. And then for the other one, when it is 20, when the return is 20, the expected return is still the same 9.25. Then we multiply with probability, which is 0.25. Then tunamalizia na no growth. No growth, nada na surplus when it is 8. When it is 8, the expected return is 10. Well, so it's 8, the expected return is still 10. Then when we go to the return, the return for the market, when it's 15, the expected return is 19.25 still. 9.25. Then we multiply with the probability 0.45. When we add them together, we shall get what we call the covariance of S and M. We shall get the covariance of S and M. That is for market and for subflux. Let's do it together. And we say 13 minus 10. Then we open the bracket, 25 minus 19.25 times 0.3. The answer is 5.175. 5.175. Confirm on your side also. 10 minus, so 10 minus 10 is 0. So everything will be 0. This one, because 0 times 0 times hiyo ingine. So any number multiplied by 0 is 0. So any number multiplied by 0 is 0. Then 8 minus 10. Then into bracket 15 minus 19.25. Then you multiply with 0.45. 3.825. I hope that is correct. 3.825. So what will be the covariance? So the covariance, you add them together. So we add them. So 5.175. 5. So that is one is how you, this is how you do it. So for you to get the covariance, sorry, not the covariance, I mean for you to get the correlation of coefficient, coefficient is equal to the covariance divided by the standard deviation of the two items, that is for the surplus and that for market, and that for market. Let me check this net first. This net, I think iko na issue. Okay, can you is it visible in your end? Is it visible on your end? So is it visible on your end? So itakuwa tunachukua, so for you to get the coefficient coefficient tumeona covariance 9. So 9 you divide by the standard deviation of the market and the standard deviation of the market, that of the subflock, which is 4.26 times 2.12 times 2.12 inakuja ngapi? Inakuja 9 point. This one will be equal to 9 divided by 9.0312. So what will be the correction of coefficient? So 9 divided by answer, which is 0.99. 0.9965. So how can you explain that one? Someone to explain it. Is it perfect correlation, strong correlation, moderate? So what can you say about that item if you were to explain? Is it moderate or perfect? Is it perfect or perfect strong correlation or just a strong correlation? Someone? So how do you explain it? So this is how you explain. You say there is a strong, to explain opportunity, we say there is a strong correlation, positive correlation. There is a strong positive correlation between security S, remember S means subflux, between security X and security Y and security M. And security M. Security M is the market, security X is the subflux. So there is a strong positive correlation. So this one is a positive correlation. So remember, this one is a positive because it's a positive figure. So there is a strong positive correlation between security S and security M. Okay. But kama ungepata 1, let us assume ungepata hivi. Once you get your answer, ungepata positive 1. So what if ungepata positive 1, ungesemaje? If ungepata positive 1, ungesema there is a strong, perfect, positive correlation. So kama ungepata hapa ni 1, so ungepata 9/9, which is 1. Ungesema there is a strong, perfect, positive correlation between security S and M. So that's how you could have explained it. So that one is start for that question. Let us go to another sitting. And we see. So another sitting. That one remember your story. So it was 10 marks. So that question was 10 marks. That's how you were supposed to do that question. 10 marks. That was question number 5C. So any question with that question? So anyone with a question? And uko na swali?
Sina swali, niko sawa.
Nice. Now let us move on. Let's go to another sitting. That's this, the next sitting. This is the sitting for August 2024. August 2024. Do you have a question there? August 2024. Yes, we have a question there. August 2024. The question is question number 3C. August 2024, number 3B. So August 2024, question number 3B. Someone to read for us. So this is supposed to be August 2024 now. Question number 3B. Okay. We grab this board. Someone to read for us as I grab the board. That's August 2024. Yeah. 2024, I think. Let me see. Yes, August 2024, question number 3B. Tusome, someone.
Okay, I'll read. The following information relates to the market price per share of Wentol Limited over a period of 5 years. Sorry. Kuna year market price per share in shillings required. The expected return of the shares of the company comment on the performance of the company based on the movement price over the last 5 years.
Okay. I hope umeandika chini the question or the screenshot. Let me give the overview. Then we start doing the question. So before I stop sharing, let me write the years. The years. So we have the years. And then we have also the market price. So for 2023, 2022, 2021, 2019, 2020 and 2019. And 2019, 28, we have 22, we have 18, we have 25, then we have 28. So I can stop now sharing. So we are supposed to calculate the expected return, and then we comment. Now, who can tell us how are we supposed to do this question? So what is the first thing in this question? So what do you notice in this question? When you look at the class ya jana, you can easily note. So you look at class ya jana. So
We're not getting you, Mami. Mwalimu, we can't hear your sound. Oh.
na sahi.
It's okay.
So nilikuwa nasema for you to compute the percentage, you need to use this formula. Forecasted market price minus the current market price, you divide by the current market price. Is that the formula that we gave yesterday? I think that was the formula.
Excuse mwalimu, I can't hear you.
Even now.
Sauti yako iko chini, like very, very low.
Na wengine hai. Use earphones kama uko na earphones. What about the others? No. The others?
We can hear you.
We can hear you, mwalimu.
So, kama munisikii, it will be advisable you use utumie earphones. So kama unisikii, you use your earphones. Kama uko na earphones, just use an earphones or headphones if you have. So that is what is recommended. Kama you cannot hear me clearly, for those when you're on the screen. Now, as I was saying, for you to compute the percentage return, so the return in percentage, we need to use the forecasted price. We less the current price, then we divide with the current price, market price, then you multiply with what? With 100. But in this case, do you have the current price from this question? Do you have the forecasted? Now, in this case, you don't have the forecasted price. So in this case, what do? We modify the formula a bit. To modify formula. So we just modify this formula kidogo tu. And how do we modify this formula? Tutasema hivi, we shall say expected return will be equal in percentage will be equal to the ending market price minus beginning market price. Then we divide by the beginning market price. Beginning, the word beginning is nandiko hivyo. Then multiply by 100, so that was 2023. So that we can start with the 2023. Let us start with 2023. Let us compute the percentage return. So 2023, what is the ending price? So the ending price is 28. Now what's the beginning? The beginning price ni ilianza 22 kisha. So what initiate 2022 ndio the beginning of 2023. Now 828 ndio the end of 2023. So the beginning of 2023 ilianza na 22, but tukimalizia 2023 itakuwa 28. So the beginning supposed to be 22. You divide by 22 times 100. Ukienda kwa 2022, if you compute for 2022, the ending ni 22 shillings. This one, but yenye ilikuwa inaanza yenye ilimalizia ndio the beginning ndio 18. You divide by 18 times 100. Ukikuja kwa 2021, if you go to 2021, the ending ni yenye iko hii ndio inamalizia 2021, but yenye ilianza ni 25 over 25 times 100. That is okay. Ukienda kwa 2020, the ending inamalizia 2020 ni 25 ndio itaingia 2021, and then yenye ilimalizia yenye ilikuwa inaanza ni 28. So tukiingia 2019 ndio ilikuwa price, so that's the beginning 28, but wakati 2020 ilisha the price was 25 divided by 28 times 100. And then 2019 so what about 2019? So 2019 haitakuwa nayo. Can you be able to calculate for 2019? 2019 to calculate aje someone? So 2019 hakuna, so our price ends here. Our percentage ends there. So our percentage inaishia hapo 2020. So let us compute them. So 2019 we shall not use it to compute the return. So we say 28 minus 22 divided by 22 times 100, which is 27.27%. 27.27%. Then 22 minus 18 divided by 18 times 100, which is 22.22. 22% what else? 18 minus 25 divided by 25, that will be equal to minus 28%. Then 25 minus 28 divided by 28 times 100, which is I think 10.71% minus 10.71%. So how to get expected return where we don't have probability? Expected return will be equal to the summation of the return, which is in percentage, divided by n minus 1. N minus 1. So itakuwa ni ngapi? 27.27 plus 22.22 plus minus 28 minus 10.71. N ngapi? 1, 2, 3, 4. 4 minus 1. Or we divide by 4 alone without minus 1. What's your thinking? Prepare na formula jana. Itakuwa ngapi? Itakuwa ni 27.27 plus 22.22 minus 28 minus 10.71 divided by 3. So this one is 3.59%. So 3.59%. So how do you comment? How can you comment that one? Someone to comment for us? So tunasema, we can see, let us comment and we say, comment, we can start commenting with our market price. So we can say, it is clear that there's recovery of the market price between 2022 and 2023. You can say there is a recovery. There is a recovery of our market price, which is MPS, between 2022 and 2023. So that is one comment we can say. There is a recovery of the market price between the year 2022 and 2023. As you can see, the price increased from 22 shillings to 28. So remember, initially the price was 2019. So, but the price reduced between 2020 back up to 2022. But the price recovered in 2023. The price recovered in 2023. That is one item we can note. Now, what about the second item? Kuna mtu ametype. Oh, okay, so. The next item that we can comment now is the, you can say, despite this recovery, you can say now, despite the recovery, there is a modest average return. So despite the recovery, there is a modest average return of 2.7 percent, which might not be attractive, which is not that attractive. No, not 2.7. It's supposed to be of 3.59%, which is not that attractive. So that's how you're not supposed to do that question. That one is the end of that question. So despite of the recovery, there is a modest average return of 3.59, which is not that attractive. So that's how you're supposed to do that question. So you just modify this equation. So this is what you need to modify. And remember, you compute expected return. So in any question, you compute expected return, the return must be always in percentage. So the return must be always in percentage. So kama return yako in percentage, then you need to convert them into percentage. Let us see another question. Let us look for another question. Let us look for another question. Let us look for another question. So tunafanya swali kama 5 hivi. Then that one we shall be the end
Mwalimu.
of. Yes.
Hello, mwalimu.
Yes, yes. Nakusikia? Olivia? Olivia umekatika tena. Olivia umekatika? Or you can type. Mbona amekatika? Olivia, you can leave and then you rejoin. Kama umekatika. Okay, as Olivia akimgoja, let's look for another question, which is April 24.
Mwalimu.
Yes.
Sir, I was asking, what if
Yes.
you are told that question continues and you are told that you do the standard deviation?
Or standard deviation. Yeah.
Yes, without the probability.
Or without the probability. So the formula for
can it be?
Yes, you can do them. You can do it. It's possible. So this is the formula of how to do it. Let me show you. So remember, for you to compute standard deviation, you need to first compute variance. Before you compute standard deviation, you compute variance. So let me stop sharing first. So I was saying, for you to compute variance, so for example, you're doing this one. How do you get the variance? It's the summation of return minus expected return. Now you divide by n. You divide by n. Let me confirm the formula. For that one, if you have yes, that one is okay. Now remember, minus 1. Minus 1. Now remember, there's something you need to know. When n is less than 30, the formula una divide. You shall divide, for example, come here return. Expected return will be equal to the summation of the return over n minus 1. Now the variance itakuwa hivi. But when n is greater than 30, you just divide by n. So when n is greater than 30, the variance, for example, will be equal to the summation of return minus expected return over n. Now our expected return will be equal to the summation of the return in percentage divided by n. So when n is greater than 30, in this case, our n was only for how many years? N was equal to 4. And that's why we less 1. And that's why we less 1. But in the case where n is greater than 30, we just divide by n. We just divide by n. So you need to look at the number of observation. You need to look at the number of observation. So in this case, tunatumia n minus. So in this case, we use, remember this one is when, this one is applicable when n is greater than that. So in this case, for example, tunaanza na 2023. Tunaanza na 2023. So itakuwaje? For you to get the variance, unasema return, our return ni ngapi? Hii hapa 2023, 27.27. Haya. We minus our expected, which is 3.59. 3.59. Haya, unaenda 2022. 2022. You can divide. You divide by number of n, but I don't prefer kudividia hapa. I prefer you add kila kitu then you divide by n. So tunafanya kwanza ya 2022. Unakuja unasema 22 2 minus 3.59. You get the summation there. Unaenda tena 2021, which is 28 minus 3.59. Unapata hapo. Allow me to rub this part. So make sure unaweka calculator yako ready for answers. Then tunaenda tunamalizia 2020, which is 25 minus 3.59. Then you find total. Now that total you divide by the number of n. So our variance will be equal to the total over n minus 1. So find those total. You can find the totals. So that's just an example. Tunasema 27.27 minus 3.59. 23.68. 23.68. Yeah. 22.22. Itakuwa ni 18.63. Then 28 sharp, 24.41. And then 25.
Excuse me, sir.
Yes.
Hiyo ya 2021 ifai kuwa negative 28.
Yeah, 2021. Oh, this one is negative 28.
Alafu ingine negative 10.
Negative 10.71.
Yeah.
So this one is supposed to be minus 28 minus 0.59, which is minus 31.59. Then your motion is minus 10.71 minus 3.59 minus 14.3. So we add them together with a quantity 23.68 plus 18. Na kuna makosa tumefanya na nyinyi mniambie. Kuna makosa tumefanya. We are supposed to get the square root. Remember square root? So we are supposed to get the square root. So you just do it. Tumesahau kufanya kupata square root of those items. So you need to find the square root. So expect return minus kama hii, tunaona hii. Inafaa supposed to be return minus expected return squared and probability summation. So hapa tumesahau kitu moja pale juu. Supposed to find the square of these figures. So ukisha find the squares, you add the summation, then you divide by n minus 1 shall get the variance. Ukishafanya hivyo, then you can get the rest. So 28.68 squared plus 18.63 squared. Yeah, plus your 31.59 squared plus 14.3 squared. So mimi napata 2372.0374. So you can get our variance 2372.0374 divided by 3. Divided by 3, which is 790.679. Then our standard deviation will be the square root of variance, which is 790.679, which will be equal to what? We find the square root, which is 28.11%. So that's how you're supposed to do that question if they ask you to determine the standard deviation. So that's how you do it. That's how you do it. So it's supposed to be squared. So you square the deviation. So that one is fine, Olivia.
Yes, Malim.
Okay, thank you. So let us go to our past paper. Let us continue with our past paper. We go to this sitting. Let us see this another sitting. So this is the sitting for April 2025, April 2024, sorry, not 2025, April 2024. The question was question number 1C. Number 1C. So April 2024, question number 1C. So April 2024, the question is question number 1C. Someone to read for us as I rub the board. Someone to read for us.
The following information relates to two potential investment, namely investment M and K. Investment M, probability returns. Investment K, probability and returns required. Compute the expected return for each investment. Roman 2, determine the standard deviation of investment M and investment K. Roman 3, compute the portfolio return assuming that 30% of the total weight is invested in the investment M and 70 in investment K.
Thank you so much. So let me, before we start doing the question, let me, so to answer an investment M, let me just put the information first, then I will stop sharing. So investment M, probability, we have the probability, yeah, 0.3, 0.4, the 0.3. Then the return is in percentage, that's the good thing. So we don't need to change them, but it was 20%, 8% na -4. And then tunaenda kwa hiyo mwingine investment K. Investment K 0.2, probability 0.2, 0.6, and 0.2. Then the return is 20. 8 na minus points zinafanana 28. Oh, so that one is fine. So number one, expected return of each investment. Number 2, the standard deviation of investment of the two investments. Number 3, assuming the portfolio is 30% of the total wealth in investment M and 20% in K, we are supposed to compute the portfolio return. That one is okay. So we can do it together. Let us start with the first one, number 1, requirement number 1. Let's compute number 1, expected return of investment M. So is equal to the summation of return and probability. So nikisema summation of return and probability is the summation of all the 3 probabilities. So summation of all the probabilities hii na hii. So how do we get it? So expected return of investment M. So expected return of investment M itakuwa ni 20 multiplied with the probability which is 0.3 plus 8 times 0.4 plus minus 4 0.3. So what will be the expected return for that project investment M? So this one will be equal to 20 times 0.3 plus 8 times 0.4 plus minus 4 times 0.3, which is 80%. So this one is equals to 8%. That's equal to 8%. We can go to the next one. Expected return of investment K. Expected return of investment K. So then we use the same formula. So probability return is 20% times 0.2 plus 80% times 0.6. So 8 times 0.6 plus minus 4 times 0.2 times 0.2. What would be the answer? So 20 times 0.2 plus 8 times 0.6 plus minus 4 times 0.2. The answer is equal to 8. So zinatofanana. The return is the same as 8%. So the return is the same, 80%. Number 2, the question requires us to complete what? Number 2, determine the standard deviation. So to the standard deviation. So for you to compute standard deviation, we need to start with the variance. Because a variance of investment M. So let's start with the variance of investment M. You know the formula for variance. Let me just give it here. Is equals to expected return. A return supposed to be the summation of the return minus expected return into bracket square. Let us see. So variance is equals to summation of return. So return of M, investment M, minus expected return of investment M squared, that is probability. Times probability. So those are the first one. So when the return is 20 for M, so 20 minus our expected return for M, 8 squared times 0.3. So when it is 8, so 8 minus 8 squared times 0, probability is 0.4 for investment M. Then when it's minus 4 minus 8, 8 is our expected return squared, our probability is 0.3. So we shall get the variance. We shall get the variance. So it upon 20 minus 8 squared times 0.3. 43.2 equals to 43.2. This one will be equal to 0 because 8 minus 8 is 0. Then minus 4 minus 8 squared. Then times 0.3. 43.2. Hey, what's that banana? Then plus 43.2, which is 86.4. So the standard deviation of M, we look at the square root of variance, which is 86.4. What will be the answer to the square root of variance, which is 9.295%. So that one is tumemalizana na hiyo. We can do the variance for investment K. Variance for K. We use the same formula there, as you can see the formula. We made the same formula, but so in a change itakuwa ni summation of RK minus the expected return of the investment K, more the probability of K. So it's supposed to be of M. Then it's for K. It's supposed to be for K. So to end the first one, when it is 20, another part when it is 20, our expected return is the hapa chini ya pili for K ni 8 squared, and probability ni ngapi? Ndio hiyo hapo 0.2. Aya, tukenda ya pili ni 8 minus 8 squared, probability ni ngapi? Ndio hiyo hapo 0.6. Then ya tatu ni minus 4 minus 8 squared, probability ni 0.2. Then we shall get the variance. Variance. So how much is the variance? How much is the variance? So someone may type, let me see. So anasema the screen is not clear. Now you wanasema hivyo, let me see. So here anasema the screen is not clear. Is that correct to the other guys? I need to confirm. The rest is the screen clear?
Yes.
So Lillian, if your screen is not clear, it is advisable you leave the meeting, then you join. So you leave the meeting, then you join kindly. So in case you don't, the screen is not clear, it's advisable you exit the group, then you rejoin. You exit the group, then you rejoin. That will be okay.
It is appearing blurry.
What about now? So ni kila mtu iko hivyo. I think it is your net. For me, kwangu naona iko sawa. Kuna venye mimi najuanga. So kuna venye huwa najuanga kama the net is not clear. But in my side, I can see the net is working. So the first one is 20 minus 8 squared, then you times 0.2, which is 28.8. Then minus 4 minus 8 squared times 0.2, which is 28.8. So what would be the standard deviation? Okay, you find the square root of 57.4. So square root of the answer of that one is 7.58. 7.589. 589%. 589%. So ukishafanya hivyo tumemaliza hiyo swali. So part B the required to calculate the standard deviation ndizo tumefanya. The standard deviation of which tumemaliza hivyo. Then the next one, number 3, they were asked to compute the portfolio return. So number 3, portfolio return. So this one is number 1, expected return. Number 2 was this one, which was supposed to be standard deviation. Number 3 is portfolio return. How do you get the portfolio return? That is expected return of the portfolio. So that one is the expected return of the portfolio. So this one is the formula. According to the expected return of the investment M, multiply with the weight, of M, plus expected return of investment K, multiply with the weight of K. That's how you're supposed to do that question. So the expected return of the portfolio is equal to the expected return of the investment M times the weight of M. So W means the weight. And if you go to the question, let's go back to the question. If you read the question, compute the portfolio, assuming that 30% of the total weight is, so 30% is for M, and 70% is for K. So the weight is, in this case, the weight is 0.3 and 0.7. So the weight is 0.3 and 0.7. So let us compute now. Expected return of the portfolio will be equal to, so the expected return of the market of the M, not market, of M. So the expected return of investment M is 8% times the weight, which is 0.3, plus the expected return of investment K, ndio 8% hapa juu. Expected return of K ndio hiyo, which is 8% times 0.7. So what would be the answer? So 80% times 0.3 plus 80% times 0.7. So the answer is the same, 8%. So the expected return of the portfolio is the same. Now you can also be asked to compute the portfolio risk. So hajauliza, but let me add for you. Portfolio risk denoted by that one. Standard deviation of the portfolio. So this is the standard deviation of the portfolio. This is the formula. This is the formula. So this is you take the weight of M squared, multiply the standard deviation of M squared plus weight of K squared, the standard deviation of K squared plus 2 times weight of K times weight of M times covariance of K and M. That's how you use it. So it's called the two assets. So this formula is called two assets method. That's the consider two asset method. Now in this case, we cannot do this question. In this case, we cannot do this question because we cannot find the correlation of we cannot find the covariance. We cannot find the covariance because we have two different probabilities. So connect probability na kona hii hapa. So the two assets has different probabilities, and therefore we cannot find the covariance of K and M. So in this case, we cannot find the portfolio risk of this question because we have different probabilities. Because we have different probabilities. We have different probabilities. So that's all about it for that question. This question was for August 2024. April 2024. Question number 1. Question for April 2024. Question number 1. So we cannot calculate covariance because we have different what probabilities. Now let me look for another question which will maybe ask your assignment this topic. I think those questions are enough. Let me give you assignments. So December 2023. Let us see if there was a question in December 2023 paper. December 2023. Yes, there was a question number 2B. December 2023, question number 2B. So assignment. Assignment, December 2023, question number 2. So December 2023, question number 2B. December to assignment. So make sure you create the question to assignment. Number 1, December 2023. The question is question number 3B. As you can see there, question number 3B. Number 2B, I mean, so it's number 2B. Supposed to be number 2B. The question says, wanasema, Job Nyangaya, going to invest into security A and B, you have the probabilities, security A and security B. So require number 1, the standard deviation of security A and B, that one is okay. Number 2, the covariance of security A and B, you know how to calculate covariance. So nimesema for you to compute covariance, the probability must be the same. So covariance of A and B. So remember, for example, itakuwa utachukua the return of A minus expected return of A, which is the summation. Then the return of B is B. Yes, minus expected return of B. Then remember with the probability. So the probability must be the same. So in this case, the probability for A and B, they are similar. So it's possible to calculate the covariance. But in the previous question, we cannot because the probability was tofauti. Then correlation of coefficient, you know the formula for correlation of coefficient of A and B is equal to the covariance in the W of A and B divided by the standard deviation of A and the standard deviation of B, of which utakuwa umepata part A. So part A and part B will give you the answer for part 3. So that's number 1 assignment, December 2023, question number 2B. Make sure you do it and you share with me. So you make sure you do it and you share with me. Let's go to another sitting. August 2023. August 2023. Do you have a question there? August 2023. There was no question in August 2023. What about April 2023? April 2023. April 2023. Yes, April 2023, question number 3C. April 2023, question number 3C. April 2023, question number 3C. The question reads that Merge Group, a portfolio comprises of Merge A shares with an expected return. Now, you umeshapatiwa, ameshakucalculatea. Just worry, for A, expected return of ameshakupea direct 10%. So you don't need to calculate the expected return. And the standard deviation ameshakupea pia of A. Standard deviation of A wamekupatia pia ni ngapi? 20%. And then Merge B shares as an expected return of, so for B, also wamekupatia expected return. Hizo ilikuwa rahisi sana. Hii kama wamekupatia 16%. And the standard deviation of B, umesema ni ngapi? The standard deviation of B wamesema ni 40%. 40%. And then the question of coefficient wamekupatia pia. So correlation of coefficient of A and B. Next one alikuwa anauliza nini ndio amekupatia kila kitu 0.4. So correlation of coefficient of A and B is 0.4. Then the weight. So weight of A wanasema weight of A is 0.3. Then weight of B is 0.7. Required number 1. Expected return of the portfolio. So it's in rising. Do you remember how to get the expected return of the portfolio? If tunafanya swali haraka haraka, let's do it. Because we have the information, expected return of the portfolio is equal to the expected return of A times weight of A plus expected return. So tunafanya hii swali haraka haraka juu kuna kila kitu. B times weight of B. So what's the expected return of A? Ndio hapa 10 times weight of A ndio hapa 0.3 plus ya B ni 16, expected return ndio hapa ni 16 times 0.7. Nimewapatia tu for free. That is the answer. Haya, unaweka kwa calculator you get the answer. Haya, kwa part B, kwa sema find the standard deviation of the portfolio. So let us do that one. Standard deviation of portfolio, that one you need to do the working. It's called the asset. You use the two asset method. Use the two asset method. So hii story ilikuwa mzuri sana. For those who did not join the yesterday class. So it is called the two asset method. Let me just show you. So this is the formula. So part B, ya hiyo swali, so part A ndio hiyo hapo. Part B wanasema the portfolio standard deviation. Inaitangwa the portfolio risk. The formula ndio hii. Ni 2 ni weight of A squared, and standard deviation of A squared, weight of B squared, standard deviation of B squared, plus 2 times weight of A, weight of B, times covariance of A and B. But in this case, hatuwezi tumia formula because already tumepatia correlation of coefficient, so we change the formula again. So the formula will be changed in this manner. So we shall change this formula kidogo tuseme the weight of A squared times the division of A squared plus weight of B squared, the division of B squared, plus 2 times weight of A, weight of B, we multiply with the standard deviation of A times standard deviation of B times correlation of coefficient of A and B. This one means covariance. Ndio hapa. So niwakumbuka formula of covariance ndio hii. Kiangalia formula hii. How do you get covariance? If you want to get covariance, unachukua correlation of coefficient multiply with the standard deviation. Ndio nimeweka hapa. Ukichukua standard deviation of A and standard of B and correlation of A and B, we shall get also the covariance. So in that case, tumepata correlation of coefficient hapa of A and B, just with direct. So what will be the standard deviation of the portfolio? This method is called the two asset method. We know the two asset method. We call the two asset method. So kutoka mjani wanakuambia use the two asset method. Just know they're talking about this. So you put it down. So the weight ya kwanza ni 0. Ya A ni 0.3 squared. We multiply with the standard deviation of A, the hapa 20 squared, plus weight of B is 0.7 squared times standard deviation of B is 40 squared, plus 2 times weight, which is 0.3 times 0.7 times the standard deviation, which is 20 times 40 itabidi imesonga songa times correlation of coefficient ndio 0.4 hadi hapo. I hope inaonekana hadi hapo. So ukishafanya hivyo, you get the answer. So una calculate hizo zote ndani, then you get the square root of that answer. You shall get the third deviation of that one. That one is all about it. Hiyo haina mambo mingi. I hope you conversant nayo. Just complete it. Now let's go to the last one. Let's look for another assignment so that tumalizane na hii swali sasa. Tumalizane na hii topic once and for all, so that when we meet the next time, we meet to do something, a new topic. Hii ikiwezekana hata in the next 1 month tuko tumemaliza FM na mwanze revision yenu mapema, kwa sababu Kasneb wanakwanga wabaya, wanaweza kurambisha chini. Anyway, let us look another one. December 2022. Do you have a question? And there's no question. I'm not going to. Yes, December 2022. December 2022. Question number 2B. December 2022. Question number 2B. Question number 2B. This question imeifanya. If you go to Telegram, there's a video called Risk and Return. Risk and Return. I've done that question there. So if you go to Telegram, go and look for a video that was uploaded last year on risk and return. Then this question is done up on Dani, so we don't need to do it. Yeah. Ukienda kwa August 2022, we have another question. August 2022. Yes, August 2022, question number 5B. August 2022, question number 5B. August 2022, question number 5B. So you need to convert this one into percentage so that you can get the, ziko in percentage actually. So you don't need to change them. So Reni, naona ziko in percentage, so ziko sawa. So what you do, you use that formula. So you utatumia formula. So remember the formula. Kwa nimeandika somewhere. Ilikuwa inaandikwa hivi. So anasema you calculate standard deviation. So you need to compute variance first. The formula ndio hii. Nachukua summation of return minus expected return over n minus 1, because the number of items is less than 30. And then you also need to compute this expected return. This one, how do you get the expected return? Is equal to the summation of the return over n minus 1. So that is what 18 plus 16 plus 10 plus 6. So hii ni rahisi hii ya kwanza hii. So is equal to 18 plus 16 plus 10 plus 6 plus 8 divided by 1, 2, 3, 4, 5. 5 minus 1. Hiyo ndio kumaliza hivyo. Hiyo haina mambo. So tuende another sitting April 2022. So kuna kitu anajaribu kufika, sijui kama nitaipata. There's something I want to show you. There's a question. This one also, there's another question here. This one is very important. Sijui kama mtaweza kufanya swali. April 2022. April 2022. April 2022. April 2022. Question number 4C. Number 4C wanakuambia number 1 expected return. I think hiyo utaweza kufanya, that is okay. So for expected return. But remember this question ukiangalia vizuri, it is not in percentage. So you need to change the items into percentage. So that question, the items are not in percentage. So you need to change them into percentage. So you compare those prices so that you can exchange them to get the percentage return. Number 2, expected portfolio return. The formula is here. Expected portfolio return. But you need to take the expected return times the weight. Blah blah blah. Now, number 3. So I'm interested with part 3. Assuming the return of A and B is perfect positive correlation, compute the portfolio risk. So compute this one. So anakuambia you compute the portfolio risk. Ndio hii hapa. Compute this portfolio risk. Now, but anakuambia assuming that the return of A and B is perfect positive correlation. What does it mean? What does it mean when we say that the security has a positive perfect correlation? Positive perfect correlation. So what does it mean? What does it mean? Yes? Ndio tumalizie swali.
Correlation
Yes,
is
Tim?
1.
Yes. No, need to know that upper correlation upper is 1. So that's what you need to know. So you don't need to compute the correlation of coefficient. You just know it is 1. So what you need is for you to compute standard deviation of security A and B peke yake. For correlation of coefficient and covariance, you don't compute it because already you know that the correlation of coefficient is 1. So hapo unakuja tunaweka 1 direct 1. You don't need to compute it. So that is the trick. And remember it is 6 marks. So remember it is 6 marks. So what's important in part 3? So the most important thing in part 3 of that question is for you to compute the standard deviation of A and B, and then you multiply with, so part A and B, then the correlation coefficient already automatically is 1. So you don't need to compute it. And if you compute it, utapata ni 1. So that question if you compute, utapata ni 1. So you don't need to compute it because already wamekwambia it is 1. So you don't need to do it. So that one you make sure you do it. So that one you do it tafadhali. Make sure you do it and mnitumie answers. Then December 2021. So kuna swali natafuta sijui kwa which sitting nikiipata. So this one we have another question here. December 2021. December 2021. The question is question number hiyo hapo. Question number 2C. Question number 2C. I think you don't need to do it. Wanasema you have been given the following information. We have probability return of A and B in percentage. Number 1, expected return of A and B. Number 2, standard deviation. Number 3, suppose the portfolio has 70% A, 30% B. Compute the portfolio risk and portfolio standard deviation. So portfolio risk is the portfolio standard deviation. Ukienda tu kwa sababu nikwambia you compute what we call the portfolio risk. Portfolio risk. Portfolio risk is the same as portfolio standard deviation. Is the same as portfolio standard deviation. So portfolio risk is the same as portfolio standard deviation. So kumbuke hiyo. So when we talk about portfolio risk, the portfolio risk is the same as portfolio standard deviation. Standard deviation, and hii formula yake hapa. That one. Hiyo ndio the formula. So that one is okay. I think we don't need that one. So Olivia, thank you. Alisema 1. That one is okay. And then so kuna hiyo swali natafuta sijui kama nitaipata. Wacha niangalie the last sitting. Kama hakuna, then I will conclude like haiko. But that's important because I want to show you something. December 2021. December 2021. December 2021. Simba napata hiyo swali. So ibado, but we have this one. You can also look at this one. December 2021. December 2021, question number 5A. December 2021, question number 5A. That one you can do it. Expected return and standard deviation. That one you can do it. September 2021. September 2021. We have that question. So September 2021, question number 3C. 2021, question number 3C. Same thing. Compute the expected return of the portfolio A and B. So pale juu unaona pale juu umepatiwa some figures. That figures inatumika kutafuta the weight. So yenye mtalemwa kufanya mtaniambia. Number 2, coefficient of correlation of A and B. That one is okay. Don't need to talk about it. Hata niangalie nyingine. May 2021. May 2021. Same too. May 2021, question 2C. May 2021, question 2C. So May 2021, question 2C. So anasema you compute the expected return of portfolio and that one of standard deviation. Hiyo ina shida. Hiyo swali kwa ni wapi? Kuna swali fulani hapo. I love that question. Let me see kama iko kwa hii November 2020. Kama hakuna hapa, itabidi tumwachia hapo. Hapa hakuna swali ya portfolio. Kama nilikuwa nataka hiyo swali, ningepata hiyo swali ingekuwa mzuri because ilikuwa iko na some aspect which I wanted to show you. So you have another one there. Hii ni swali gani? Which sitting is this? November 2019. November 2019, question number 3A and B. I think that one can do it. November 2019. Question number 3A and B. So number 3A wanasema differentiate between systematic and unsystematic risk. We did this that one in lesson 1. Systematic and systematic risk. Number 2, third division of security X and Z. Relative risk. Relative risk means coefficient of variation. Relative risk means CV. So remember the coefficient of variation, that is the relative risk. So measure risk per unit. Then advice on the two security, that one is okay. You are in a mambo. Yes, ndio hii nilikuwa natafuta swali. Thanks God. The same sitting November 2019. So hii nilikuwa natafuta November 2019. The question is question number 4C. So this is the question I was looking for. Now look at this question. Look at this question clearly. This one inasema hivi. A financial analyst has predicted the following return of the security of two companies. We have the Carroll and Reef Ltd operating in the same industry with the financial year that 1st December 2019 and a different state of economy. So we have the state of economy, probabilities, and their forecasted return, which they are in percentage, which is a good idea because we don't need to compute the percentage return. Our proposed investment is considering investing 500 shares in the firm. So you should invest 300 in Carroll and the balance, which is 200,000 in Reef. The prospective investors feel that the two asset portfolio will not guarantee him the required return, but will assist him to eliminate the diversified risk. Require number 1, on the basis of two asset portfolio, this one, two asset method. Hiyo nilikuwa nawaambia two asset method, that's the two asset portfolio. Number 1, determine the portfolio return. So the portfolio return, the same, vilikuwa tunasema, for you to get a portfolio return, let me show you using this method, the same thing is equal to, so the expected portfolio return, ama expected return of the portfolio, unachukua the expected return of the Carroll Reef, you multiply with the weight of the Carroll Reef, then you add the expected return of the Carroll Reef na ingine ilikuwa gani? Carroll na Reef. So Carroll na ingine ya Reef. There is the weight of the Reef. And then hiyo iko sawa. That's the formula. Expected return of the portfolio is equal to the expected return of the Carroll and the weight of the Carroll plus expected return of the Reef and the weight of the Reef. And then portfolio risk is the same as the formula in the 8 asset method. That is the correct one. Just do it. So that is what I wanted to show you. And you're here, Apple. Let me share with you again. Then we end the class. You're here, Appa. Where is it? You're here. So we have the Carroll. You can see Pariju. We have forecasted return. We have the Carroll Ltd and we have the Reef Ltd. So for you to get the expected return, you need to calculate the expected return of Carroll, then the expected return of the Reef, so that you can, once you get them, you can use them to calculate the expected return of the portfolio. Then the actual risk. The portfolio actual risk, remember, the portfolio actual risk is the portfolio standard deviation. And the formula the square root of the weight squared plus the weight squared of the other one, plus 2 times weight of Carroll times weight of that one. You multiply with the covariance, or you multiply the standard deviation, or with the coefficient of correlation. So any question up that point? And
No question. Thank you.
Stephen?
No question, I'm okay.
What about nani mwingine nimeona hapa? The other person is alikataa kuongea, Joseph. Joseph, do you have any question?
Sina swali.
Oh, where is it, Joseph?
Hapana, ni Cynthia.
Okay, sawa, no worries.
Okay, thank you.
Now that is all. So make sure you do this assignment, and you shall share with me your answers. So you do this assignment. So this is your assignment, and make sure you do it. Then you just take a pic using the cam scanner. Then you share with me. Then tutaangalia where where you need the assistance. But with that, That one marks the end of our topic, portfolio return or portfolio risk and analysis. We shall start from next time when we meet, we shall start with this topic, which is called the cost of capital. So next time we meet, our new topic will be called the cost of capital. Cost of capital. So that will be our next topic. So be ready. So when we meet, we shall start from the cost of capital. So that's all for today. I want to wish you a good night. And thank you for attending the class. So you keep on reading because exam is around the corner. So good night.